Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about corporate tax rates in India. Now coming to the current affair, there has been serious discussions going on that the central government has to reduce the tax rates for larger companies or larger corporates in order to boost the investment cycle in the economy. So this is the current affair. We will analyze, is there a need to reduce the tax rates or the tax slabs for the larger companies or for larger corporates in the country, and whether this will help in increasing or improving the investment cycle in the economy, and what can be the advantages or what can be the possible benefits of reducing the tax rates for larger companies. So we will discuss all these issues. We will see what would be the impact on fiscal deficit, what will be the impact on investment, what would be the impact on the revenue of the government, etc. So let us start. But before we begin the lecture, let me tell you, we are providing pen drive courses for all competitive examinations, including SSC bank courses, UPSC optional, various teaching courses, railway examinations, defense examinations, RBI grade B, NABARD, UGC NET, UPSC Civil Services Examination, law examinations including CLAT entrance examination, state PSC courses and various other professional courses. So for more details, please visit our website www.studyiq.com or make a call to any of these numbers for more details. Now moving on with the lecture, let us first understand what is the background of this reduction in corporate taxes in the country. In the year 2015, the government pointed out that the corporate tax rates in India are too high when compared to other countries. So this was the point made out by the government in the year 2015. And in the year 2015, the government laid down a roadmap for bringing down the corporate tax rate in the country from 30% to 25% by the year 2019. That is in the next 4 years. So this roadmap was created in the year 2015, and following this, in the 2016 budget, the government made an announcement, and in the announcement, government said that the new manufacturing companies, that means those manufacturing companies which are incorporated on or after March 2016, that is from the next financial year onwards, will be taxed at 25%. So this announcement was made by the government in 2016, and this was one measure by which the government tried to bring down the corporate tax rates in the country. And this 25% tax rate would apply to the corporates only if it was new, the first condition, that is if they are incorporated after March 2016, and secondly, if they did not claim any profit or investment linked deductions, investment allowance or accelerated depreciation. So if there are no other claims, the new corporates can claim for this tax reduction at 25%. And the government also announced or lowered the corporate tax for companies with a turnover of less than 5 crore by 1%. That is from 30% it was reduced to 29%. So this is applicable for those companies whose turnover is less than 5 crore. So this was to support the small and medium entrepreneurs. And in the year 2017, the income tax for companies with an annual turnover of up to rupees 50 crore was reduced to 25%. So this was in the year 2017. So the same scheme, that is reduction of tax rates to 25%, this was extended to those companies whose turnover was up to 250 crore in the 2018 financial year. So we can say that in a phased manner, the government has brought down the tax rates for companies on corporate tax from 30% to 25%, and by the year 2018, this was extended to all those companies whose turnover was less than 250 crore. So with this, around 99% of the companies filing income tax or tax were moved to the 25% rate, and the estimated revenue forgone for the government was around 7,000 crore in financial year 2019. So government was able to include 99% of the companies under the 25% corporate tax rate. And when the tax rates come down, the revenue for the government decreases, because now government has lesser revenue in the form of taxes because of lesser tax rates, and 7,000 crore of revenue was forgone by the government. So this could be eliminated if the tax base increases. So we'll come to this later in this lecture itself. Now let us understand why the government did not include larger companies in the ambit of this rate cuts. We have seen those companies which are earning less than 250 crores were included in the 25% tax rate. So this covers almost 99% of the companies. But the rest 1% who earns more than 250 crore turnover every year, they were exempted from this exclusion. So what was the rationale behind this for the government? Around 7,000 companies were included in this 1% category. That means around 7,000 companies earn more than 250 crore turnover every year. So definitely this 1% of the companies whose turnover is more than 250 crores, they account for the largest chunk of economic output, because when output increases, the turnover also increases. So in terms of economic output and also in terms of central government's tax revenue, these 1% companies has a significant role. So they were excluded from this 25% tax rate, and in fact the tax burden for this 1% of the companies moved higher. We will see how. So corporate tax rate for the higher companies were 30%, but for other companies it was capped at 25%. So 30% is what these companies have to give, but their tax burden was higher because of the inclusion of surcharge and cess. So if surcharge and cess were included along with the corporate tax rates, the tax rate was around 35% in 2018, which was 33.99% in 2014. So we will see that for the large corporates, there has been an increase in the tax burden compared to the smaller corporates or smaller companies. So we will see how this happened. In the year 2015, the surcharge rate. So what is surcharge? It is tax on tax. The surcharge rate was increased from 10% to 12% for companies with income of more than 10 crore. And in the year 2018, the higher rate of health and education cess, that is 4%, added to the burden of this larger corporates. So this is in addition to 30% of the corporate taxes plus 12% surcharge and 4% cess on education and health. And along with this addition in the rates, certain tax incentives given to the corporates were withdrawn by the government. And another reason behind the increase in tax payments is the adoption of the BEPS rules in India. So BEPS is base erosion and profit shifting rules. And also in the year 2016, India adopted CBCR, country by country reporting. So under the country by country reporting, the multinational entities have to provide details about the operations of the group companies in all parts of the globe. So this data had to be provided to the tax authorities. So in fact, what happened with the large corporates, they had to pay higher rates of tax to the government. And suppose if this 25% or 5% reduction or the net 25% corporate tax rate was applicable to the corporates, it is estimated that the government would have to forgo around 95,000 crore in the financial year 19. So with the cut in the tax rates for smaller companies or corporates, government had to forgo 7,000 crore revenue. But if it was the case with larger corporates, around 95,000 crore rupees would have been a revenue loss for the government. And also this is the case with direct taxes. Now also the case with indirect taxes. The government rolled out the GST or the goods and services tax. So GST is also not completely mature, or we can say that the full potential of GST has not yet been reached. So there is issues with regard to tax revenue under the GST regime. So along with that difficulties, if government had applied the same tax rate cut with direct taxes, especially in corporate taxes, this would have resulted into a great or huge revenue loss for the government. So that was a rationale. Government had kept this 1% of larger corporates outside the ambit of the rate cut. Now let us understand what are the global examples. So according to the data that is compiled by the KPMG, countries across the globe are moving towards lower corporate tax rates. That means they are reducing their corporate tax rates. Now if we look into the average corporate tax rate globally, in 2003 it was 30.19%, but in 2018 this reduced to 20.6%. That means India is much above the global average in collecting the corporate taxes, especially with 1% larger corporates. The tax rate is 30%. And coming to the Asian average, in 2003 the Asian average was 29.42. In 2008, the Asian average has reduced to 23.03%. So the current peak in the corporate tax rate in India, around 35%, it is the highest among the BRICS countries as well as the Asia Pacific countries. And among BRICS grouping, Brazil is the only country that has tax rates higher than 30%. It has a tax rate of 34%. Now we have seen that globally there is a move towards cutting down the tax rates. What is the rationale behind this? This is to induce investment, or the government is providing lesser tax rates so that the companies will have higher profit margins, and this profit will be used by the company in order to invest in capacity expansion and to augment the business. So this higher rates of investment will help in the growth and development of the economy itself. So that is the rationale behind the governments across the globe to reduce the corporate tax rates. Now the government of India also in the year 2016 announced that they would be concentrating on reducing the tax rates. But what really happened is that even though the tax rates came down, there was a hike in the surcharges and cess. So this has increased the tax burden of the corporates. Now let us understand what is the way ahead or what has to be done. So we have seen the government of India has already cut down the tax rates for smaller companies. But the tax rate cut on the smaller companies will not have much greater impact on the private investment in the economy. So to boost the private investment, it is important to cut the tax rates or reduce the rates for larger corporates who will undertake large or huge private investment in the economy. And secondly, reduction in the rates will also help in higher compliance. So this is what we have discussed in the beginning. So when there is a rate cut, this will lead to higher compliance. For example, the corporate taxes account for around 1/3 of the total tax collections of the government. And the central government is expecting a growth of around 13% in corporate tax collections in financial year 2020. So if the tax rates are reduced, this will lead to higher compliance and therefore the revenue collection of the government will shore up. This will also address the issue of tax evasion, which is very high in India now. Larger companies are paying lower taxes than smaller companies. So a reduction in the tax rates could help in improving the compliance of these companies, and also it will help in greater scrutiny by the tax authorities, and the tax collections will also be improved. And along with that is the investment. The private investment by the corporates will also increase because of their increased profit margins from reduced tax rates. You can find the PDF of this lecture on my Facebook page, and for any queries regarding your UPSC preparations, you can get in touch with me on my Facebook page, or you can email me at joyce.studyiq@gmail.com. Thank you.